Graham Burnett. I'm a general partner at Red Planet Capital, which was a venture capital fund formed in 2006 with NASA. It exists in order for NASA to get access to the deal flow of those wonderful, innovative new technologies that entrepreneurs like you are coming up with, that otherwise they wouldn't hear about until 5 years later when you started advertising your ultimate products. They figured out at NASA that their entire R&D budget was a fraction of the amount of money that the private equity venture capital funds were putting into developing these innovative new technologies. They wanted to get access to it, very similar to like Siemens wants to get access to it. And the way that you learn about these things early on is by being part of the investing community and seeing the deal flow. Now that said, I'm here tonight not because I am a venture investor, but because I'm a founding principal of a new company that's in formation right now called Augustus Capital. Augustus Capital is a new in-formation investment bank that is being created in order to take advantage of the changes in the Jobs Act that we're here to talk about today. We've seen a gap happen between the wonderful financing that angel groups are able to do to get companies started and off the ground, and the size deals that venture funds, as they've gotten larger and larger and larger, are wanting to participate in. And if you're trying to raise money in the $10 to $15 million range, perhaps to expand your product, it's gotten very difficult to do that in today's environment. We believe that we can build syndicates of accredited investors that fill that gap.
So, by the way, is Zahaba still here? We need to load the slide deck. And I have the clicker, but I don't know if it's actually loaded. So. My name is Mark Perlmutter, and my background is as a retail broker. So I was in the trenches with many of you, raising capital for private deals, talking to individuals, trying to sell it the old way. Get a guy to invest $100,000 in a startup company, take a risk with us. Maybe do second round, a couple $1 million 2 years later to try to get the company over its first hurdle into profitability. And I'm very passionate about using the technology of the internet and social media and combining that with laws that are seasoned as well as the new ones that are coming. And you heard a little bit from Roger earlier. We're going to probably have to revisit some of those just to get a ground of being, so we're all talking about the same sets of laws and what's legal, what's not legal, and we'll do that in context. I was hoping we had a slideshow to do that, but
oh well.
I don't know. Let's see if any clicks happen here. No, that was an off. Okay, so I don't have any. I'm going backwards on somebody else. Sorry about that. So I guess my slideshow isn't loaded. So I'll do a quick.
Just turn it off.
Yeah. So I'll just do a quick ground of being for all of us around what the laws are now, what the laws will be someday, we don't know when. And then that'll give us the context to talk about how we use crowdfunding or the expanded advertising that will be allowed someday on the privates. Is that okay? Good setup? Okay. So, as Roger said earlier, if you want to raise money from anyone, whether it be a family member, a stranger, or the general public, you either have to do a registered offering and have a permit, or you have to fit an exemption that allows you to do that. In Silicon Valley, as Roger said, we use accredited only most of the time so that it's highly advised by your lawyers and it's the safest way of raising money. The problem is not all of us know lots and lots of accredited investors. So an intermediary like a broker can help, they're legally allowed to. When the laws change, you'll be allowed to advertise to strangers you do not know and sell to them as long as they are accredited. That's the new 506C, it's called. And that will change everything as far as how money is going to be flowing from the accredited, so I believe. And I think your model is brilliant, by the way. I think it's beautiful. As far as crowdfunding, now we're talking about smaller dollars, a maximum of $1 million. And so it really isn't in the same league as this 506 advertising to the accredited, but it might be useful for the earliest stage of seed money, maybe. Because what it does is it allows you to get beyond just the people you know to maybe their friends. And you don't know them yet, but they might tell their friends to come look at your offering posted on crowdfunding. And that's not legal yet, but it will be someday, and we'll have the rules on that someday. But the current use of crowdfunding that I particularly like is proof of concept. And this doesn't require you to raise any equity. If you go out and get 100 or 200 pre-orders of your product from your fans, that goes a long way when you sit down with someone to get an investment of equity who might be a professional investor. So crowdfunding today, what's called reward-based crowdfunding, the Kickstarters and the Rocket Hub and the Indiegogos, the big players, if you can pre-sell your product, you have proof of concept, and you might get some feedback. It might be your first beta test. So that's one of the appropriate uses of crowdfunding as it currently is today before the new law. When the new law comes, we'll know what the rules are, we'll know how much latitude you have, and we'll know how we can do it and how we can use it. But in the meantime, I think the proposed laws on the 506 advertising is the most exciting part, which we can talk about. So now that we've got the introductions, do you have any, do you want to start a conversation? So you said you're going to use it as a broker-dealer model. Will you be vetting deals? Will you be recommending those deals? Will you be acting as a principal?
Our vision with Angelus Capital is we will be regulated as a broker-dealer. We'll have to follow all of those rules, and we will have on our staff people that are professional researchers that will analyze the companies, and we will select the best of those companies to offer to the investors that we have in our database that have signed up to see deals. Most of the people up here, and I wouldn't be surprised if many of you in the audience today, get emails on a daily basis saying, here are 10 or 20 companies that I think you should look at. I get those, they go into my junk mail folder without me ever opening them. We have to avoid that. And we have to avoid that by having value perceived by the investors that are in our database. So, with a lot of things that are done by investment banks today, we have to do, but we have to do in a way that's very efficient.
And obviously, at the strategic investor level, you're probably looking at a situation where the deals are very vetted when they come to you, or you do a lot of vetting. Is that correct?
That is absolutely correct. We spend a lot of time. Going back to the point that you just mentioned, it makes a huge difference how that opportunity finds its way into my inbox. If it's Joe Doe sending me an unsolicited email, it probably ends up in the trash bin pretty quickly. If it's Carol Sands, I'll say I better take a careful look because it's pre-vetted by her already. But the point I really want to emphasize here is I think crowdfunding will create a different type or category of company compared to what is our typical investment company. We are typically investing in companies that take at least 10, that might be wishful thinking actually, that take 20, 30, 50, $100 million in capital to build them and bring them to a break-even point. I don't think you can take a company there with crowdfunding. You're not allowed to raise as much, but also I believe once you've started going down the path of crowdfunding, it makes it very, very difficult to shift course and actually then get on the VC track. Because we look at certain things and how your charter has been written, what are shareholder rights, and who has a proxy to vote for all those shareholders, and so on, which I believe make it very, very difficult to change course from a crowdfunded company to a VC-funded company.
That's a great point. Let me just comment. In the earlier session, one of the questions was, if you started out as a crowdfunded company, what would you do if you wanted to go talk to professional investors like venture capitalists? And the comment was passed over too quickly. I think there is an opportunity that if you build in a buyout at a multiple, let's say 3, I think the early investors might be happy with that. And they might be willing to be bought out, and then it would clean up the cap table and make it a possible candidate for professional VCs. What do you think of that?
But why would we want to?
Well, the question for me is, when we fund a company, we want to fund the company. We don't want to buy out other shareholders. We don't want to spend the first $3 million on making a couple people happy. I don't mind people being happy, but that's not how we want to deploy our capital.
Excellent point. So, how will the 506 affect the groups that you work with, Carol? The expanded 506.
So I think on a practical basis,
because a large portion of what we're talking about is going to be very impactful outside of Silicon Valley, where they don't have as easy access to funding sources as we do here. But within Silicon Valley, I mean, we're pretty blunt and perhaps even brutal about the difference between dumb money and smart money. And when you have no choice, you take dumb money. But if you have a choice, if you have the opportunity to have someone like the four of us involved in your startup who can provide not only the cash that you need, but the business connections and the network and the business advice to help you, A, avoid mistakes, and B, to get out of them quickly when you actually make them, so that your probability of survival goes up, is pretty remarkable. And I don't think at any point the market is going to shift away from smart money.
Yeah, I would echo that. I'm a crowdfunding skeptic, and there's the devil's in the details, and the details in the crowdfunding has a lot of devils in them. There's just as an example, I haven't seen a single startup business plan that has been the same 6 months after funding. I don't know if anyone else has seen one, but I haven't seen it in my existence. And one of the protections is that one is that you have to file your plan. It's a public document, forget stealth mode. And then on top of that is that for any errors or omissions in this plan that's going to be worthless in 6 months, the directors and managers of the corporation are personally liable. There's no way I'm sitting on that board. I got news for you. So, you know, it's going to create a lot of messiness and complications, and I agree. I think in areas where there is no venture capital in other parts of the country, where people want to invest in the local community, support the local community, really for putting money into company for kind of non-investment reasons. And there's really good data that's come out of the Kauffman Foundation for angel returns, and what are the determinants of higher angel returns? It's domain expertise, involvement in the company, and the amount of due diligence you do going into a deal. All three of those are missing in crowdfunding.
So I'm going to talk out of both sides of my mouth now. I actually see some really positive things out of crowdsourcing. And not every business is going to be venture backable to start with, nor do they want it or need it. And crowdsourcing allows inventors specifically who have an interesting and totally different product to be able to say to a very large population, hey, I think I can build this. If I can, would you be interested in buying it? And having that kind of pre-ordering and quite literally using one of my favorite ways to fund a company, which was with other people's money, to be able to take the pre-orders and the total amount that is raised from that is enough to go get the space, buy the raw materials, create the product, and if they priced it correctly so that it actually has some good margins, the company could very likely be viable in a very short period of time, and the VC world
Now you're talking
doesn't
about
care.
reward crowdfunding, right? Let's just clarify.
I'm sorry?
You're talking about reward-based crowdfunding, right? Not
Yeah.
equity.
Pre-sale.
Yeah,
Yes.
pre-sale.
Yes.
So just for clarity for the audience, that is legal. Kickstarter, they allow you to pre-sell your product and test market it. Equity is not legal yet. So.
And echo that, the reward space, I mean, Pebble Watch is the poster child for that.
Yeah.
Any one of my portfolio companies that can go out and pre-sell $10 million worth of goods and then go off and build the goods, I would, as long as they can fill the production line, I would tell them to go do it in a heartbeat. It's when you get into the equity-based crowdfunding side is where I think it's really fraught with difficulties.
Yeah. And just to echo that, the original petition on the SEC site 2 years ago was $100 maximum investment by people that live 250 miles from the issuer. That was the original petition that started this whole thing. It got, in my opinion, it got blown up by the politicians for political reasons. It's a political year. But that wasn't the original intention by the petitioners at the SEC website. It was to help little companies raise a little bit of money locally to open up a second restaurant down the road in the next town, or a bakery, or expansion, buy a new oven to make more pizza. Another green dry cleaners is going well in one town. They want to open up another one. So those companies would never go public, and they shouldn't be selling equity to private investors who never have an exit. So crowdfunding itself in general has many different possible uses. It's got to be specifically tailored. It's got to fit the company's growth plan. It's got to fit the company's interest in how it's going to exit those investors and repay that. It also needs to fit the company's expectation of when it's going to be in profit mode and be able to repay. Technology companies and research in the biotech field have a long gestation, a long time before they have approvals to go into the market oftentimes. This is not a suitable crowdfunding at all for the small investor to put money in and expect to have an exit. No, that's not appropriate. But a company that's maybe just a consumer services product ready to go to market, and they can get sales right now, and they just need some marketing money, that might be. And then there might be a bond rather than an equity for the crowdfunding instrument, so that it self-liquidates.
So if we could, in the life sciences area, use crowdsourcing as a way of doing clinical trials, boy, that would be awesome. It'd be great if the population could talk to us directly and say, yes, I have that disease. Yes, I'd be willing to take this experimental treatment or try this device or whatever.
There's actually a cancer. I just heard about a cancer crowdfunding site that wants to fund an alternative cancer drug, and all the people that have that cancer are contributing money, just like you said.
Yep.
There are three big areas of risk that every company that starts out has to go through if it ultimately succeeds. And there's first the technology risk, that you can actually do what you want to do. This comes early on as you prove that your concept works. Then there's a market risk, where you have to prove that there are people that are out there that are willing to pay good dollars to get what you've now proven that you can do. And then there's expansion risk. As you grow the company to a scale that becomes large enough that you make money and your investors ultimately get a payback on their return. I think one way of looking at these changes in the investment world is which varieties of investors are willing and able to help you address those risks. Now here in Silicon Valley, we are blessed with the very best angel organizations of anywhere in the world, in large part because we've had a thriving technology and healthcare entrepreneurial organizations and history in this area. People have done really well, both financially and learning. And they can take that money, invest it in other companies that are coming along, take their knowledge, and mentor new entrepreneurs as they're growing. So this is why angel investors are particularly well working with seed companies, where the new technologies that are being developed can get the benefit of people that they'd never be able to afford to hire as consultants. But what about as they're moving into the marketing area and want to grow beyond that? They need more money. What are your thoughts on that?
Well, maybe a sidestep first. We've spoken a lot about the extremely powerful angel community here in Silicon Valley. If I recall correctly, seeing some of the statistics, actually angel investment is more balanced across the United States than venture capital investment is. I think venture capital investment is like 50% roughly is in California, Northern and Southern California combined, and then you have a little bit in the Northeast and a little bit in Texas. So I think angel investment is more balanced. But I think behind that is a message. And the message is to build an ecosystem which can provide huge amounts of financing, huge amounts in the sense of tens of millions or even hundreds of millions. That's a different ecosystem than an ecosystem that is able to provide a couple $100,000 or maybe a couple $1 million, $5 million or so. And that also means quite likely we're building different companies for that. You brought the example, which is really a small business, whether it's a pizza shop or a service provider, a laundry service or something like that. That's one thing. But there's also high growth or potentially high growth companies like mobile apps or so, which don't require those millions and hundreds of millions in financing. I think that's where crowdfunding has a chance. It also is what's the development cycle of those companies. How quickly do you overcome? You did a great job in describing those 3 hurdles. How long does it take you to cross those hurdles? The typical portfolio company that we have probably takes 2 or 3 years or so to develop and verify the technology. Then you need to find the first couple customers, and that's when you really verify the business model behind it and the willingness to pay for that. And then you still have to scale it up. So that's another how many years? I'm not sure whether investors who are coming through a crowdfunding vehicle will be that patient.